Should you choose a fixed interest rate or the floating interest rates for your education? It's a decision that could save or cost you lakhs in the long run. Fixed rates give you stability, while floating interest rates change over time and sometimes for the better, sometimes for the worse. But which one is truly right for you? Hi everyone, I am Simran, co-founder at Epicred and your trusted guide to the education. Today, we will break down the difference between the fixed and the floating interest rates, how they work, and a pro tip that will help you choose the best option for your situation. And by the end of this video, you'll know exactly which interest rate type will work best for you so that you can pay less and worry less. So let's dive in. Alright, so let's start with the basics. What is an education loan interest rate? Simply put, it's the extra amount that you pay on top of the loan amount that you have borrowed from the lender. And when you take an education loan, you get two choices. You either lock in a fixed interest rate that stays the same for the entire loan tenure, or you can go with a floating interest rate that moves up or down based on the market conditions. Sounds very simple, right? But let's break them down further. A fixed interest rate is exactly what it sounds like. It stays constant throughout your loan period. This means that your monthly EMI payments will always be the same no matter what happens in the economy. So there are no surprises and no sudden increases. Let's say you take an education loan of 10 lakh at a fixed interest rate of 10% over 10 years, your EMI will remain exactly the same for the entire repayment period. This is great if you prefer stability and want to plan your finances without any stress. But here is a downside. If the interest rate drops in the future, you won't benefit from the lower interest rate. So if you are okay with a little bit of risk in exchange for the potential savings, that's where floating interest rates come in. A floating interest rate doesn't stay the same. Instead, it changes based on the market conditions, usually linked to something called the RBI's repo rate or the EBLR, that is external benchmark lending rate. So here is how it works. Let's say if you take an education loan of 10 lakhs at a 9% floating interest rate, if the RBI reduces the repo rate next year, your interest will also drop, which in turn will lower your EMI. But if the interest rates go up, you will be paying more than what you expected. A floating interest rate usually starts lower than a fixed interest rate, which means cheaper EMIs in the beginning. But since it can increase later, you need to be prepared for the fluctuation. Apart from this, there is a major advantage of the floating interest rate, that is, you can close the loan early without paying the entire interest amount that would have been charged over the full tenure. So now you might be wondering, how often do floating interest rates actually change? Well, it depends on your lender. So if you are choosing the floating interest rates, always check how frequently your lender resets the rates. For example, if you take a floating rate loan in January 2024, your interest rate may change in July 2024 and again in January 2025. So it completely depends on your lender. Now let's talk about the real risk. How much do floating interest rates actually fluctuate? Most of the time rates go up or down, usually by 0.25 to 1% every year. But when the inflation is high, rates can shoot up suddenly. For example, in 2019, the floating education loan interest rate was 9% to 11%. But during the pandemic in 2021, the rates were cut and dropped to 7.5 to 9%. And then again in 2023, the inflation caused them to rise again. So while floating interest rates may save you money when the rates drop, but they can also cost you more if the rates rise later. So let's summarize the key differences between the fixed and the floating interest rates. Fixed rate, stable EMIs, no surprises. It's the best if you prefer financial predictability. But you miss out on the savings if the rates drop. Whereas the floating interest rate, it starts cheaper than the fixed rate, saves money if the interest rates fall, and it also has a risk of higher EMIs in case the rates rise. So the golden rule here is, if you want stability, choose the fixed rates. If you can handle some risk, choose floating interest rate. Here is a pro tip to make the right choice. Check the RBI's repo rate before deciding. If the repo rate is on the lower side, choose the fixed interest rate because rates may rise later. And if the repo rate is on the higher side, choose the floating interest rate because rates may drop in future. And if your loan tenure is less than 7 years, go for fixed. But if your tenure is 10 plus years, floating interest rate may save you a lot of money over the period of time. So now you know exactly how fixed and floating rates work and how to choose the best one for your needs. Comment below which one you are choosing, fixed or floating. Let's discuss. And in case you are confused about which one is the best one for you, you can reach out to our expert loan counselors. They'll guide you through the entire process. Also, don't forget to check out our EMI calculator, which can guide you to plan your repayment better. At Epic Red, we help you compare 15 plus lenders all at one place. So do reach out for the best loan deals. Don't forget to like, share and subscribe for more financial tips. See you in the next video.